thing that is useful about learning about payroll. The first part that's useful is knowing what your pay stub looks like and what it's actually telling you. In fact, before I prepared this lecture, there was a couple of things that I didn't really understand in terms of how to calculate income tax. I just basically let the accountants and the HR and the payroll just take out whatever they said I'm supposed to take out without really knowing exactly why they were taking that amount out. And so we'll learn why and how that calculation is done. We'll talk about the difference in terms of how pay is assigned based on regular work hours versus overtime hours versus kind of works for hire and things of that nature. So that way, if you are planning to be like a bookkeeper someday or take accounting with Daryl in the future, you will have some exposure to this. Maybe you've already taken accounting, and this will be easier. But probably the reason why you're in this class is to help prepare you for the business curriculum rather than just taking the one class after you've done all the stuff. So what is our roadmap here? We're just calculating different types of pay based on whether or what the terms are in terms of how frequently you get paid, gross pay based on piecework. So if you get hired to do a certain amount, how much are you getting paid per unit, differential pays, commissions, etc. So maybe you work on commission, maybe you get advances, maybe you have a salary and get commission on top of that. Maybe you have a position where you get overtime, or maybe you're doing some sort of work for hire. And then the next part is to calculate, explain what a payroll register looks like or a pay stub when you're calculating these things, or if you're getting a pay stub in the mail or online when you get on your payday. I get paid tonight, overnight. So at midnight tonight, my pay stub will appear on my MCC, and then I can cross-reference, okay, my insurance, my union dues, my retirement contributions, and taxes. And then calculating those taxes is the last thing that we'll do. So if you've heard these terms before, or if you've ever had a job, you probably know what these terms are. But these are the typical 4 choices for payroll cycles. So if you're getting paid weekly, I'm trying to think. I think I've been paid in all of these at some point in my life. So my first ever job, I was paid weekly. My boss, it was a family-owned place, and he would handwrite our checks out every single week. So there wasn't direct deposit. There was no setup for direct deposit. It was just a handwritten check with my pay every week. And then that's what I got. I was getting a whopping $130 some a week to work 35 hours a week. It was wonderful. At the time, I thought it was great. How I wouldn't even answer the phone if that's how much I was getting paid a week. Bi-weekly means that you're getting paid every 2 weeks. So most people think, okay, well, I'm going to get paid every 2 weeks, so I'm going to get 2 paychecks out of the year, or 2 paychecks every single month. Well, that's actually slightly different. Bi-weekly means you distinctly get paid every 2 weeks, which means that you're going to get paid 26 times a year instead of 24. Because if you're getting paid twice a month, which is what semi-monthly is, you would get paid twice a month, which can be aggravating because then the dates fluctuate. Weekly, you get paid the same time every single week. Bi-weekly, you get paid every 2 weeks, same time every 2 weeks. Semi-monthly, you get paid twice a month, but that date might fluctuate because they typically try to make it the 15th of the month and the last day of the month. Well, February is 28 or 29 days. January has 31. And it depends on if the last day of the month falls on a weekday or a holiday or a weekend. So semi-monthly, you get a lot of fluctuation in terms of your pay dates after the 15th. And even that can sometimes vary. And then if you're getting paid monthly, you get paid once at the end of the month. And I don't like it. 2 places I've taught at paid monthly. My previous job paid monthly. I only got paid once a month at the very end of the month. Even though it was a full-time position and with benefits and all that stuff, you only got paid once a month, and it was pretty excruciating because your bills are due all over the place. And then I adjuncted at an institution where they paid once a month. And then that was frustrating because it was just sometimes 28, sometimes the 30th, sometimes the 31. I hated months that had 31 days and the 31st wasn't a weekend because then you had to wait an extra 2 or 3 days to get your next check. When you're already scraping by because you've been waiting and waiting and waiting. So if you're getting paid $50,000 a year, don't we all wish that, or for more than that? This is your gross earnings. So now, this is your gross earnings per pay period. So if you have a $50,000 a year salary, then if you're getting paid every week, you're going to get your gross pay will be $961. You're getting paid every 2 weeks, then it's $1,923. If you're getting paid twice a month, which means that you don't get those 2 months out of the year where you get 3 paychecks. So that's kind of the cool thing about biweekly is that there's 2 months out of the year where you get 3 paychecks. You get $20.83 a month if you're doing, or a paycheck if you're getting semi-monthly, and then if you're monthly, you get $41.66.67, which seems awesome when you're like, oh man, I'm getting this like big old hunk of money at the end of the month, but then you don't get another hunk of money until the end of the next month, and then it's like, oh man, that's not great. But if it's the job and that's how they pay, that's how they pay, and that's what I did. And then I got a different job. So my first job paid weekly. A few of my adjunct jobs paid semi-monthly. Delivering or pizza shops were weekly, grocery stores were weekly. My current job is actually the first time I've ever been paid bi-weekly, I believe. I might have gotten paid bi-weekly doing one of my summer jobs in college. And then my previous job was monthly. And so I can attest that bi-weekly is much preferred. But basically, these cycles are determined by the institution that's paying you. So how do you get paid? Well, gross pay if you're working a standard schedule. So in America, that's a 40-hour schedule. So if you're part-time, you're working less than 40 or some number less than 25 or 32. It depends on how it's framed. But if you're working less than 40 hours a week, then or equal to 40 hours per week, then it's just multiplying whatever your wage rate is, if you're getting paid hourly, times the number of hours that you work. So even if you're on salary, what they'll do is they'll treat your hours worked per week as 40. So even if you work 20, they pay you 40. If you work 80, they pay you 40, unless you have overtime attached to your salary. However, if you work over 40 hours a week, then you actually get time and a half. So if you're making $10 an hour for those overtime hours, you get paid $15 an hour. So if you want to calculate your overtime pay, you take however many hours you worked minus 40, and that'll give you your hours of overtime pay. and then you multiply that times 1.5, and that'll give you your overtime pay rate. And then the gross pay is just the sum of those two things. So when you're getting paid $10 an hour and you work 50 hours, you get paid 10 times 40, which is 400, plus 10 times 1.5, which is 150. So your gross pay in that example would be $550. So again, 50 hours, $10 an hour. So this would be 400 because it's 10 times 40. And then this would be 10 times 1.5 times 10, because this is your wage rate, which would be 15 times 10, which is 150. So your gross pay is $550 for that week. Now that's gross pay means total. So that's not actually how much you'll get in your paycheck, because you got to take out taxes, Social Security, Medicare, all those fun taxes. If you have insurance, it comes out. If retirement comes out. If you have any sort of other benefits like life insurance, that comes out. Dental, medical, all that stuff. Union dues comes out. So the amount you actually receive is not this, unless you are skirting by on either you're getting paid so little you don't, well, you'd still have to pay FICA and all that. So chances are it's still not going to be equivalent to this unless it's under the table in cash. So here's another example. So we have an employee. They have daily logs of how many hours they worked. Now, depending on where you work, this calculation might be a little different, but we're going to do the simple calculation of overtime. So for R. Valdez, they worked 13 hours on Monday, 8.5 on Tuesday, 10 on Wednesday, 8 on Thursday, 11.25 on Friday, and 10.75 on Saturday. So that means they work 61.5 hours. Now, some institutions, it depends on either the state or the field or the contract. If you work more than 8 hours in a day, you get overtime for the hours beyond 8. But now that we've been revising work schedules, that's not necessarily the case anymore. Some people do 12-hour shifts, some people do 10-hour shifts, 10 hours, 4 days a week. Some people do 12 hours, 3 days a week, and then they have a 7th 8-hour shift in the biweekly period. It really just depends on the institution, but historically in standard labor practices, over 40 is the overtime. So this person's making $9 an hour, which no wonder they're not making that much money, because they're only making $9 an hour and they're working 61 hours a week. That's a lot of work. But if we know that they're working 61.5 hours, we know that 21.5 of those hours are going to get paid at time and a half versus just regular time. So that means that the amount that they're going to get paid for those overtime hours is actually $13.50, because 9 times 1.5, 9 plus 450 is $13.50. So the gross pay is going to be for the 40 hours of earnings, which is 40 times 9. So that's $360. And then 21.5 times the $13.50 pay rate, which is $290.25. So that means that R. Valdez's gross pay during that week was $650.25. So some of you might take economics with me next semester, next year, something like that. We talk about something that's known as the labor leisure model. And so typically what that means is it has a backwards bend to it. So what that means is typically if you get paid more, you work more. But after a certain point, you'd realize that either A, it's not worth it because you value your time off, either because you're working yourself too hard, or B, you're getting paid so much that you don't need to work as much to have the same living that you were having prior. So in this example, this person, maybe they're working a lot extra because they know that once they get past that 40-hour threshold, that their wage rate goes up. And so they're banking on making that $13.50 an hour for the overtime pay. But we don't know state of mind here. I don't know what they're working in, but all I know is probably based on our current circumstances that this is probably a job that'll be difficult to fill. So what about straight piece rate pay? So this is something that one of my friends just got, did a project like this, where in this example, they're paying for them to make dolls. What my friend did was he was hired to make little desk name things, 3D printed. So instead of like the traditional nameplate with like the engraved name and the little slot, and then it sits on the desk, a school district commissioned him to 3D print every single teacher's name, and then they can put that on their desk. And so if I remember correctly, they had 800 employees that they had to make them for, and they paid him $2.50 per one. So if he was getting paid $2.50 per unit and he made 800 of them, that means that that was a $2,000 job in terms of gross revenue or gross pay. So whenever you're doing a straight piece rate pay, it's just multiplying the price that you're selling them for, the rate that you're offering, times the number of units produced. And it doesn't have to be the same all the way. You might charge higher based on different levels or lower based on different levels. It just depends on the situation. So in this example, Ryan produced 900 dolls. He was paid 96 cents per doll. Assuming that there's no defective units, what would his gross pay be? It would just be the $900, or excuse me, the 900 units times the 96 cents per unit, and he would earn $864. So here's a different example. So Abby Rogers is, instead of Ryan, is being, where Ryan was paid basically per unit, and it was the same price for every single unit. Abby Rogers has a different pay scale where basically there's a range where if you hire her to produce a small quantity, then the per unit rate is lower. If you hire, and then the more you produce, the higher the per unit ranges, but this is marginal. So marginal means additional. Marginal means additional. And this will be important when we talk about tax calculations at the end of this lecture. Basically, these pay rates are bracketed off. So what this means is, since Abby is producing $300, all of them are not going to be sold, or she's not going to be paid $1.25 for each doll. She's only going to be paid for $1.25 for all the dolls that exceed 200 in total. So since she's only making 300 dolls, she's going to get 100, or she's going to get $1.25 for the last 100. She's going to get 75 cents for the 50 between 151 and 200. She's going to get 62 cents for the 100 between 51 and 150, and she's going to get 50 cents for this 50. So in order for her to calculate her gross pay, she has to multiply these individual pay rates times the number of units that fall within that category. So for this one, she's going to get paid $25. For this one, she's going to get paid $62. For this one, she's going to get paid $37.50. And then for this one, she's going to make $125. So when you add that all together, you get 50 cents on the end. I should be using a better color than this. Okay, 50 cents for that. And then 125 plus 37 is 162. Plus 62 is 224. Plus 25 should be 249.50. So again, you have to attribute the values based on the ranges. So when you get taxed, this is the same process. It's a marginal tax, meaning that for the first X $1,000 that you earn, you pay this percentage of it. And then for after you've reached that threshold, you've maxed out. So like, let's say the first $5,000 that you earn is paid at 10%, or you pay a 10% tax rate. That means that if for the first $5,000 that you earn beyond like the standard deduction, you're paying 10% of that. So you're paying $500 in tax for that 5,000. And then for the next 10,000, you're probably paying 12%. So that means that you're paying $1,200 on that 10,000. And then after that, it goes up to 22%. So when you're paying taxes, because you make $100,000 a year doesn't mean that you're going to pay 30, let's just say the tax rate's 33%. You're not going to pay $3,300 or $33,000 in taxes on federal. You're going to have your standard deduction, so that lowers it to 90,000. Then you pay 10% on the first 10,000, so that's only $1,000. And then it's like for the next 20,000, it's 12, so you only pay $1,200 for that, so you're only at 2,200. And then for the last 80, maybe you pay 35%. So really, it's going to be less than what people think it is. And the same is true here, where you're not making whatever $475, you're making less than that because of the ranges. So what about a straight commission with a draw? So what is a draw? Well, what is a commission? A commission is a certain percentage of the amount that you sell. So this could be in the form of royalties and intellectual property, or it could be in the form of a proportion of your sales. So real estate agents, they go work on commission. So if they sell a $100,000 house and they get 3% commission, that means that they make $3,000 in their sales. A draw is an advance. So like maybe you write a book and you've negotiated that 12% of your sales of your book go to you and the other 88% go to the publisher. Or let's make it similar, let's make it 20 and 80. So let's say that you write a book and 20% of the sales go to you and 80% of the sales go to the publisher. Well, in order for you to survive and actually write the book, you need money. So what you do is you ask for an advance from the publisher. So the advance, maybe they pay you $100,000. Okay. You ask for $100,000 advance, meaning that you're getting $100,000 in income during the year in which you write the book. So that way you can live comfortably and rent some hotels for inspiration, go on vacation to scope out the locations of your book if it's on Earth, and things like that. And then the book ends up selling $1 million worth of copies. Okay, so that means that if the book sells $1 million worth of copies and you make 20, that would mean that you would be owed 200,000 and the publisher would be owed 800,000. However, the advance is not charity, it's not a salary, it's basically an upfront payment. So that means that from that 200,000, you're only owed what's left after the $100,000 in advance is kind of repaid. You're not really repaying it, they're just taking it off the top. So that would mean that you would actually receive $100,000 after the book was written and sold, because you already got your $100,000 for actually writing it in the first place as an advance. So that's how an advance works. Now let's do another example. So I guess Logan Company, I don't know who Logan Company is, or the publisher of the book, I don't know, but Logan Company pays Jackie Okamoto a straight commission of 15% on her net sales. So net sales is their total sales minus their sales returns. In May, Jackie had net sales of 56,000. Logan gave Jackie a $600 draw in May. So what that means is that they basically gave her $600 up front. Maybe she just started working for the company and she needed a few $100s to put a security deposit down on a house or an apartment, and she needed that money so she could survive for a few days until her first check came in from commissions and sales. Okay. So what that means is that $600 is going to be taken off of whatever her actual sales commission salary is, because she already received that money. So if she sells $56,000 and she receives 15% of that, well, then we just multiply 56,000 times 0.15, and that should give you some answer in the neighborhood of $8,400. If she's already received $600 in a draw, then that means that she will be owed $7,800 in gross pay. What about a variable commission scale? So maybe if you sell up to $35,000 worth of stuff, you get 4%. Over it in a certain range, you get 6%, and then over it, you get 8%. So this kind of goes back to like the piece situation, but instead of it being like you're getting paid per unit, you're getting paid a proportion of the amount of sales that you generate. So again, this isn't necessarily the actual rates that you would charge. It's just an example for the situation. So if Jen Ring sells $160,000 worth of front door video camera doorbells, what is Jane's gross pay? Well, again, we have to slice and dice this again. Instead of just multiplying straight, okay, 6% or 10% or 15% times the 160,000, we have to break it up into our ranges. So 35, if she's maxed this out, that means that this is going to be 35,000 times 4%. If we want to convert this to a decimal, we got to move over 2 spots. So it's going to be 0.04 times 35,000 is your calculation. First one. So 35,000 times 0.04 plus this next range is only 10,000. She's exceeded that. So it's going to be 10,000 times 0.06 plus the difference between how much she actually earned in 45,000 or how much she sold in 45,000. So 160,000 minus 45,000 is 115,000. at the 8%, so 115K times 0.08. So when we do this calculation, we get 35,000 times 0.04, which gives us 1,400. Then we do 10,000 times 0.06, which is going to give you 600. And then 115,000 times 0.08 is going to give you $9,200. So that means Jane's gross pay is going to be 9,800 plus 1,400, which is $11,200. What about salary plus commission? So maybe you get a job where they still pay you a regular salary for consistency, so you can rely on that. And then you get bonuses or you get additional salary in the form of your commission. So here was you're getting a commission at a straight percentage. This one says that your commission is dependent upon how much you sell. This one is saying you're going to get some money just based on how much you work or how much we're going to pay you just as a flat fee spread out over X paychecks. But then we'll also pay you a certain amount in that consistent commission rate. So if Logan Company, I guess they've got a lot of employees and they pay them a bunch of different ways, but it's good for our class, I guess. Logan Company pays Joe Roy a $3,000 monthly salary plus a 4% commission for sales over 20,000. Last month, Joe's net sales were 50,000. So calculate Joe's monthly gross pay. Well, first and foremost, we know he's making 3,000 in a salary, so that's taken care of. That'd be nice to have a good job like that where you know you're taking home $3,000 and then you can make more based on how ambitious you are or how successful you are. But anyways, so you get 30,000 as your base, and then they sold 50,000. They get 4% bonus on top of for every dollar that they earn beyond 20,000. So if you do 50,000 minus 20,000, you get 30,000. So that means 30,000 times your 0.04 is going to be, I believe, $750. So that means that if you add this together, that Joe Roy's salary, monthly pay, sorry, not salary, is $3,750. Oopsies, I did this wrong. It's not $3,750. I thought of 0.04 as 1/4, not 0.04 as what it is. So that's actually 1,200. And then you would actually get, let me just erase all this, 1,200, which is 4,200. So my apologies for that miscalculation. The one time I got confident not to use the calculator, I totally messed it up. So we're getting $1,200 for that. So 4,200 is the salary plus commission. So what does your paycheck look like, or what are the things that you have to figure out when you're getting paid? So a payroll register is actually like what your bookkeeper is going to see. But a lot of these things are going to be things that you're going to see on your invoice or your payroll statement or your pay stub or whatever it is, whether it's a document that's online or it's attached to your check that you rip out and sign and send off to your bank. whatever the process is these days, these are all things that you're probably familiar with, but I wanted to point out for completion purposes. So the first thing is the name of the employee. Second thing is their allowances. So when you apply for a job and you get hired, there's usually a W-4 you have to fill out, and the W-4 is your tax classification. So you usually fill out this form both federally and at the state level, what your allowances are. So if you're married, there's allowances. You claim one for yourself. You claim one if you're married. You might claim one if you have children. It really just depends on the state and what the stipulations are. But typically people that are married claim two, one allowance for them, one allowance for their spouse. So that's what this A spot is saying. They're married and they're claiming two allowances. That those allowances are what are going to dictate how much is withheld in taxes every pay period. So if you're wondering if the number was arbitrary, it's not. There's actually a calculation that you can do on your own to determine whether the amount being withheld is appropriate. But it might be tricky because you might not remember how many allowances you claim. Maybe you were single when you started the job, then you got married and you forgot to update it, things like that. I think when I got married, I think it took me a year before I updated all the tax stuff. So I actually got a pretty nice refund that first year because I was getting more taken out. And then the year after, I was used to the big refund. I didn't get as big of a refund because I was holding more in my paycheck. It depends on how you are with your own budget. For me, I prefer to pay as little tax as, or for me, I prefer to pay as little tax as possible. So like if that means my refund is small, that's fine. I just don't feel like I need to give away money and then get a big check in February or March that for money that I could have already had invested, spent on stuff, paid off debt with, etc. But some people, like, they are reliant upon a nice fat check in February from a refund, so they like to under claim exemptions so that, or they have a certain amount withheld every check, and then it's kind of almost felt like it's held in a trust, and they get it back in the beginning of the next year. It really is dependent upon things. But what you shouldn't do is you shouldn't over claim exemptions, because then you might end up paying a significant amount of tax during tax season unless you save it up. But if you're used to being like an independent contractor and having to claim this and pay it, then maybe that's the way you go. But so this B thing is cumulative earnings. I know it looks like cum-eam, but it's cumulative earnings. So this says that Janet Wong, up until this paycheck, the accumulation of all the money that she's earned has been $127,200. I want this job. I want a job where I get $127,200 a year. Don't we all? So Janet Wong, but prior to her 49th week paycheck, had earned $127,200. She's on salary and she earns $26.50 a week. So C is identifying what her average pay each week is. And then when we get to this box right here, this is saying how much she's earning this pay period. So she didn't work any overtime. Maybe she's salary exempt. She gets her $2,650. There's no overtime pay. So her gross pay for the week is $2,650. When you add in the cumulative earnings prior to this paycheck and the gross pay of this check, then her cumulative earnings, including this pay, go from $127,200 to $129,850. And then the next box is saying what amount of her salary or her gross pay is taxable by law for FICA. So the actual table that we're seeing here is actually different than what the so the answer would actually be different here. The base in, I think, 2018 was around $129,000 or 128,400. So what that meant was that once your salary goes beyond $128,400, then you stop paying Social Security taxes. However, the base has increased from whenever this slide was made or whenever this book was published to this year. And so I updated the number. The base now is actually $142,800. So that means you have to earn $142,800. And any dollar earned after that, you don't have to pay Social Security taxes anymore. How much are Social Security taxes? Well, they're 6.2%. It's 6.2% to you and 6.2% to your employer. And then Medicare is 1.45%, and there's no cap to that. So what this is saying is that based on the old Social Security base, after $1,200, Janet Wong was over $128,400, so she didn't have to pay any more Medicare, or excuse me, no more Social Security tax beyond that rate. So that's why it only says $1,200 instead of the full $2,650. But if it was 2021, she'd actually have to pay the full 6.2% on the $2,650. So then actually her Social Security would be higher in 2021. But again, Social Security 6.2%, and there's a cap at 142,800, which unfortunately probably most of us will never make enough beyond the cap to not pay into Social Security. Even if you made like $142,801, it would feel good to be like, that one last dollar you earn ain't being taxed by Social Security. And then next year it'll probably be like 200,000 because of inflation and because we've underfunded Social Security for so long. So unfortunately, I think we'll all be paying into Social Security forever. And if you're an employer, you get it from both sides, because you pay if you are an employee and you own the business, you pay your tax from paying yourself, and then you also pay your tax from paying your employees from the employer side. And then Medicare is 1.45%. So if you actually multiplied 0.062 times 1,200, you'd get $74.40, which is how much Janet is paying in Social Security taxes. And then if you multiply 0.0145 times 2,650, that'll give you your Medicare taxes, which are $38.43. And that's just your taxes for Social Security and Medicare. So our two kind of social safety nets that still exist from the New Deal way back in the day. Although they're usually for people that are retired and people that are older. So you pay into when you're young, and the goal is that you are going to have money on the other side. But that's not all you pay out in taxes. FIT here is your federal income tax. SIT is your state income tax. So if you're living in Texas, Washington, Wyoming, and a few other states, which of those would be zero? It would be your state income tax. So I previously came from a state where there was no state income tax, so that number would be zero in a state with no state income tax. Does anybody know what the state income tax rate in Michigan is without looking it up, or just guess?
4.25, right?
You are correct, Kyle. It's 4.25%. So we can conclude that Janet Wong does not live in Michigan because her state income tax is not 4.25%. If you divide 159 by her gross pay of 2650, you'll determine that her state income tax rate is 6%. So Janet Wong pays 6% at her state income tax, and then she pays $342.83 in federal income tax. And so if you divide 342.83 over the 2650, that means her effective federal tax rate is 12.93%, which seems pretty low for someone making that much money. And the reason why is because of the fact that your tax rate, again, is marginal and progressively marginal. So that means that all of her income isn't paid at the 22% rate that you would expect it to be at based on her income level. Only the part beyond the threshold of, I can't remember what the number amount is, would be taxed at 22%. Then there's a range that's taxed at 12%, and then there's a range that's taxed at 10%, and then there's the standard deduction, which is the amount of income that is untaxed based on the poverty line or based on whatever Congress passed in 2017. And then don't forget, they paid health insurance too. $100 a week seems seems like a good deal for health insurance these days, if you can get any. And so after all of that is taken out, the amount of money that she takes home is $1,935.34. Which, if you multiply that times 52, that means that at the end of the year, she takes home $100,637. Still not much to complain about there. So if you want to actually calculate her income tax, these are the tables. These tables are probably outdated, but they still give you an idea into the process. When we said that she had 2 withholdings, these withholdings give you a minimum standard deduction, so to speak, over the frequency in which you get paid. So if you have 1 allowance, then that means that the first $4,150 that you earn in a year is not taxed at all. However, if you're married or you're able to claim 2 allowances, you double that. So it would be $8,300 that wouldn't be taxed from her income. So once you have determined what their allowance is, so in this case, Janet has 2 allowances. So and she's being paid weekly. So that means that her allowance for her specific weekly paycheck is going to be $79.80 times 2, which is basically $159.60, I believe. That means that any income she earns beyond $159.60 is subject to this table 9.2, meaning that the first, and then in addition to that, you still get this $222 that's not taxed either. So if you do 222 times 52, it's really that the standard deduction is about $16,000 for a single person. But anyways, if you make less than $222 a week, not with after allowances, you still don't pay any tax. But then once you're past that $222, then you follow the marginal tax brackets. If you make $222 over 222 but less than 588, then you pay 10% of your tax. But if you make more than that, then you just pay $36.60 because it's $366 in that range. So you would pay $36.60 for that money. And then the money after that, between 588 and 1711, you pay 12% of that. But if you make more than that, then you would just add the $36.60 plus the maximum amount from that other range, which adds up to be about $171.36. And then for every dollar that you earn between $17.11 and $33.95, you pay 22% on that specific money. If you end up making $33.95 after your allowances in the 222 per week, mind you, this is weekly, then you pay 24% on the next $3,000. And then if you make $62.80 per week, then it's 32% on that marginal amount plus the previous amount. So what this number here is telling you is basically if you've maxed out the previous levels, that's how much your tax would be for that amount of money. And then anything marginal beyond that is taxed at the 24, 32, 35, and 37% rate. So if we use this information, we can actually calculate her income tax. So if she makes $26.50, she's married with 2 allowances. We know that she has 2 allowances, so I told you based on that, we're gonna subtract $159.60 from her salary. So that leaves her with let's see here. $24.90.40. Well, if we go back to the table, we can see that if she made $24.90.40, she's going to fall in this range right here. We can also subtract $17.11 to determine that she's going to have to pay $778.60 at this 22% rate. Sorry, I was off by $1, $779.40. And so as a result, she's going to pay an extra $171 in taxes for that specific $779.40 for at 22%, plus that $171.36, which means that the total amount of tax she has to pay is $342.83 in federal tax. If we go back to this sheet, that's how much she paid, and that's how much we calculated from the tables. So if you made $1,000 and you're single and you have 1 allowance, you make $1,000 a week. Yeah, we'll say $1,000 a week. So you make $1,000 a week and you have this allowance. What is going to be your tax rate? So if you go through this, you subtract $79.80 if you're single. You're down to $920.2. You get $220 tax-free, so subtract $222 from that. And you are down to $698.2. 698.2 falls in this range here, so that means you're going to pay $36.60 minimum plus 12% times the difference. So 698.2 minus 588 gives you $110.20. You multiply that times 0.12. So 110.2 times 0.12 gives you 1322. So you would pay $49.82 in taxes, federal taxes, if you made $1,000 a week. I don't. Does anyone in this room make even make $1,000 a week? $1,000 a week would be a $52,000 a year job. We went through this one. So again, this is outdated. It's actually now, what did I say, 141,200, I think. So we know that, well, this is just the calculation that we did before with Social Security. Because the cap for them was 128,400 in this example, and they had already made 127,200, then that means that they are only liable for $1,200 of the Social Security tax. Since Social Security tax is paid out at 6.2%, we multiply that times 1,200, so which is why they had to contribute 74.40. And then Medicare is always 1.45% of your gross, so that would be $38.43. So here's some other taxes that employers are responsible for. So unemployment insurance. So when the pandemic hit, we had expanded federal unemployment insurance that was paying people an extra $300 or $600 a week or things like that. And then in regular times, unemployment is typically administered and still is at the state level. So federal unemployment tax says that there's a 6% tax on the first $7,000 that's paid to employees, and state unemployment is 5.4% tax on the first $7,000 paid to an employee, which can be credited against the federal unemployment rate. It's kind of like a minimum wage type thing, where rather than having to pay one to the federal program, one to the state, since it's usually administered by the state but funded by the federal, just like a state could have a minimum wage that's lower, but the federal supremacy clause in the Constitution says federal law trumps state law if there is a conflict of laws. So in this case, unless the law is enumerated to the state itself. So like Wyoming has like, in Kansas have like federal or have state minimum wages in like $5.20 an hour. But because the federal one's $7.25, they still have to pay it $7.25 unless there's some weird exception that they take advantage of, which they'll try to. So, so that means that the actual amount of tax that they have to pay to the federal government is 0.6%, not 6%, 0.6%, because they're credited that 5.4% that they're already paying to their state unemployment. So let's say a company has $20,000 worth of wages and 4,000 of them are exempt for whatever reason. What are the company's state UTA and FUTA taxes if the company's state rate is 5.8%. So if the state level is 6% and the federal level is 6% and the state level is 5.8%, that means the federal rate is going to be 0.2%. And the state rate is 5.8%. So if they have to pay 5.8% on the first seven, so 16,000 of that is liable because they had 4,000 exempt wages. So if they do 16,000 times the 0.058, that gives us $928 that they'll have to pay to the state. And then their federal is actually still 0.06, there's going to be 0.6%, because the 5.8% is a special rate. So they're only credited for the unemployment that they're paying as is in the legislature, but because they have a poor record, they're still having to pay an extra amount in unemployment insurance to the state, but they're still held liable for that 0.06%. So they actually have to pay $96 to the federal, but they're actually paying more than the effective rate of the federal because of their state law saying that they have a poor employment record. So just to do a couple problems and then we'll be done for this evening. Bernie Roy works 9 hours Monday, 6 hours Tuesday, 9 hours Wednesday, 7 hours Thursday, 6 hours Friday, and he makes $8.95 an hour. What's his gross pay? Well, we can add these up: 9, 6, 15, 24, 31, 37. He works 37 hours a week at $8.95. There's no overtime, so it's just straight multiplication. 37 times 8.95 gives you $331.15. So what about this one when there's potential overtime? So Blue, my boy Blue, works for me. We work 12 on Monday, 9 on Tuesday, 9 on Wednesday, 9 on Thursday, 9 on Friday, 3 on Saturday. So if we add that all up, we get 21, 30, 39, 48, 51. So 51 is the total number of hours, but 40 go to the regular hours, and then 11 are going to go to overtime. If he works for $8 an hour, it's crazy how outdated these numbers feel like. I mean, there's still probably people making $8 an hour somewhere, but it's crazy how much wages have changed and how much underpaid people have been for very long, that relative to costs increasing, that $8 an hour seems low when $8 an hour was higher than what I was being paid to do my job in 2015. I was getting paid less than $8 an hour to do something 6 years ago, and I was making way less than that in 2006 when I first worked my first job. Anyways, if you're getting time and a half, 8 times 1.5 is 12. So your overtime rate's going to be 12. So if you work 40 hours at 8, that means you can make $320. 11 times 12 is 121. So that means Blue is getting paid $441 a week for this week. Whoa, I guess I made a mistake. I think that they made a mistake. I don't know how you get 6840 out of 12 times 11, but it's what I said. Actually, it's 132, so it's still wrong. We're both wrong. Goodness gracious. $132. So this should be 452. So yeah, the number's right, but I don't know where that 6840 came from. So some of my slides I make, some of the slides are borrowed from the publisher, and I kind of Frankenstein them together. But I usually rely on that. This is the second error that I've acknowledged in this PowerPoint, that I fixed one of them that they had wrong, and now I guess I didn't see this one. The final number is correct. He made $452 that week, but I have no idea where that 6840 came from. So Lang makes 480 units of something. He's paid $350 a piece to make them. Just multiply them together. He makes $1,680, but I got to confirm that to make sure, because yeah, 1680. So my apologies for miscalculations today, and I apologize for the error in the PowerPoint, but the final answer is correct. Now, what if we have Ryan, the apple picker, who gets paid different prices based on the range of apples that he has picked? So it's orchard season, it's harvest season, pumpkin spice season, spooky season. So this could be something that could be happening right now. So Ryan picked 1,600 apples. If he, for every apple he makes up to 1,000 or picks up to 1,000, gets 3 cents. So 1,000 times 0.03 plus the next 600 are 5 cents each. He only picked 1,600, so he's not going to make 7 cents for any apples. So if we do that, we get 1,000 times 0.03, which is $30 plus 5 cents times 600, which is, I think, also $30. It is. So that means that Ryan made $60 picking 1,600 apples, which I don't know what the process is. I don't know if you just like whack them down with a stick. I don't know if you're standing on a ladder pulling them generously one by one. But $60 doesn't seem like a ton unless you're like really efficient at it, like just shaking the tree and they all fall off and you pick them up. But I mean, apples, well, if you think about it, apples, I don't know, let's say they're $1 a pound and you get like 4 per pound or something like that, or maybe 3 per pound. I guess that's where the markup's coming from. So here's one with a commission. This one's straight commission. That means that you're just multiplying the commission rate times however much they made in that commission sales. There's no salary here. So, but this is a scaled commission rate. So we don't just do a straight multiplication. We got to piece it up. So if Ron Ear sells $155,000 worth of sales and his commission rate is the following, that means that 80,000 of it will be at this rate. 20,000 of it will be at this rate. And then the remainder, which is 55,000, will be at this rate. So we're doing 80,000 times 0.02 plus 20,000 times 0.035 plus 55,000 if we do that, we get 80 times 0.02, which is $1,600. Then we get 0.035 times 20,000, which is another 700, plus 0.04 times 55,000, which gives us another 2,200. So we get, oops, that's 4,000. $4,500 as his gross earnings. We can calculate Social Security and Medicare tax. So again, they're using the base rate of 128,400. Logan made 128,300 before the pay period. This period he makes 3,000. Since $100 of it will go to this, and then everything after that is exempt based on this example, he's really only going to pay $6.20 in Social Security, and then Medicare is just 1.45% times the 3,000, which is going to give him, I think it's going to be $43.50, but it is $43.50. So does anybody have any questions about that?